to another exciting episode of Finance Footnotes. I am your friend and host, Brent Stransky, joined by my friend, colleague, and co-host, Zach Mineur. Today, we're going to catch you up on what happened in the first quarter of the year. There's been a lot going on, Zach, so we got to cut right to it. And first, like always, we're going to start with what happened, where we are in the marketplace. And Zach, it was a pretty terrible quarter in the first quarter. S&P 500, which is the primary stock index, was down 4.6%, making it the worst quarter in 4 years. Pretty volatile. There's some news events that may have happened. You may have heard about it, folks listening at home. But I have a cutout here from the Wall Street Journal from earlier in the month, and it shows that while the S&P was down, NASDAQ also down about 6%. There was some good news for those coffee drinkers out there. Prices came down by about 14%. And for those of us who love chocolate, also down 45%. So not all bad news, Zach. But the big news, of course, is what happened in the equity markets. And if you're looking at the chart here, folks, this is from the Wall Street Journal this morning. And it shows you the three primary market indexes, the Dow, the S&P, and the NASDAQ. And if you had to say which letter of the alphabet that looks like, Zach, what would you say? Yeah, it looks like a V to me. You had this, there's a lot of negative news in the press, of course, about the war in Iran, and for good reason. But boy, we were in the middle of, as of yesterday, Zach, a 12-day, as of Monday, I guess last Friday, 12 days positive for the S&P 500. It's exceptionally rare. It's happened, I think, 10 other times since 1950, according to some of the data. So one of the fastest pullbacks to all-time highs in recent history, right, Zach? So things look pretty crazy.
We talked about this, like, the last 4 or 5 times that we've had these corrections. It just seems that the timeline of these cycles just keeps speeding up, and that the news flow keeps speeding up, and that the time it takes for things to turn and to change and to rebound keeps speeding up, which makes it very difficult to try to do any sort of timing around these kinds of things, and this one especially. I mean, when we were sitting there at March 30th or whatever that day was, kind of right at the end of the quarter, things didn't look great. And now here we are, 3 weeks later, and not only has it rebounded, but it's up for the year.
Yeah, up for the year about 4% as of Friday. And that was, listen, folks, at the end of March, the end of the quarter, the market went from being up about 5% to being down about 4.6, as we talked about. So nearly a 10% drawdown, very fast drawdown. But then even faster, and there are reasons for that we'll talk about in a second. Zach, before you go to the next slide, I'm sorry to hit you with the pop quiz.
Okay.
And you probably already know this, but of course the driving force in the media with venom every single day was about the oil prices and how it's going to affect the greater economy. Oil peaked at maybe $100, $110 per barrel in March, right? And we're floating around that point. Yeah. What was the all-time high in oil prices, West Texas Intermediate? Do you know?
All-time high?
All-time high.
I think we got close to 140 back in 14, something around there. 10,
yeah, okay. Very, very close. All-time high. Going to the next slide. All-time high for oil, $147 a barrel, going back to 2000.
I didn't look at this either. I really didn't look at it.
I know.
2008. Okay, so okay.
This is why we're paying you. I'm glad. It would have been really awkward if you got it wrong. So good job there, my friend. But I think what's important is to adjust this for inflation going forward, which 2008, I hate to say it, folks, 18 years ago. I hate to say it. But carrying that forward for inflation adjustments, $213 per barrel. It's, there's an open hot war in Iran. The Suez Canal is closed. And Zach, oil prices are trading at half of what they were inflation adjusted. Just blows my mind. So I think all this to say that, the news is certainly pointing at oil as the major reason for the volatility, but there's also timing. Like the market likes to take a breath from time to time, and there's other contributing factors that could have led to the drawdown. And that's all I plan to say about the war in Iran.
Yeah, for sure. Adjusting that for inflation, $213. And if we were, projecting kind of, worst case scenarios of 140 to 150. And it's just interesting how, times change that, back in 2008, the world was still a lot more dependent on Middle Eastern oil. That was really before the U.S. shale boom and the extraction and the coming online of the U.S. production. So yeah, times have certainly changed since 2008.
And times certainly have changed, but I don't think I heard this anywhere else in the news feed, my friend. So you're getting this exclusive here from Finance Footnotes. One reason to tune in here, just as a reminder here about important data going forward. I want to turn to another reason, another interesting dynamic here in the marketplace is that sentiment, Zach. Sentiment across the board has just been so pessimistic. I can't believe it. I have a chart up here from the University of Michigan, has been measuring consumer sentiment since I think 1952. And believe it or not, last April, which is this month, sorry, the April data 2026, the lowest on record, like
Below
Vietnam War,
COVID.
COVID crisis, the
2000.
financial crisis, like 3 years of the financial crisis, and people
Yeah.
are more pessimistic now. There's a lot of reasons for that. I think part of it's the news feed and the political energy and atmosphere at the moment. But I'm just shocked by this. It's just crazy to me. People who are typically dour spend less money. I think that's the takeaway, right, Zach?
Yeah, and it's been the most hated bull market, growth economy. It's been that way for 5 years, really. I mean, you can see even like the peaks of, I guess that was probably 2023, ish time frame of when that kind of last ticked up on consumer sentiment, and that was like the median. That barely got back to the midway point of consumer sentiment. I mean, we've just been down in the basement of folks' feelings towards the economy for
With
quite some
inflation
time.
managed, with unemployment, the
Yeah.
unemployment rate, in the low fours, it's really unusual. Turning to another slide that just kind of hammers this point home. One of my favorite metrics is the CNN Fear Greed Index, which is a kind of an average of 8 different important indicators. You can get this data for free. It's really important, but it just kind of takes a litmus test of where folks feel about the economy based on 8 different measures. And you can see that first chart I have on the screen there. This is it's showing you the very end of April when the markets were down, the war in Iran, the news feed, which is so angry, so negative. And it was 10. I mean, average is about 50. So you can see that 10 is extremely low. It's about the lowest it's been in the last year, except for the last year's um, tariff crisis. But then fast forward 2 weeks, Zach, where do you think it is? It's 70. This calls to mind Warren Buffett's favorite adage: you want to be fearful when others are greedy, and vice versa. So man, I just an idea. People were very and are very pessimistic, and that certainly drives people's sentiment and economic decisions. All right.
And it's hard to have I think if you look at those consumer sentiment numbers, I mean, it's the complete opposite of, irrational exuberance, right? I mean, it's hard to have a really prolonged downward trend when people are already so negative because when you're feeling that way, you're not taking outsized risks, you're not overextending yourself. And so I think that's just been the position really throughout this bull market where I think the COVID timeframe scarred a lot of people psychologically, and I just think that even
Mm.
though there was a major resurgence in consumer spending for sure, it has not extended to the level of um, that irrational, nothing can possibly go wrong, everything's fantastic. That's when you get big market dislocations. That's when everyone's on the wrong side of something. And I think that part of that is why we continue to see these V bottoms is that when you get a correction, there's not a lot of outsized positioning that needs to be filtered out.
Covered. Yeah.
Needs to be covered.
So much cash on the sideline, and there are many reasons for the market dynamics. But it just seems crazy to me. Like oil, Suez Canal as at this very second is closed again, but
Hormuz,
markets flat. It's
Suez.
ridiculous.
Suez is in Egypt.
What did I say? The Suez? Oh my God. All right. Moving along, though, we can certainly move along. I want to talk about Tax Times Act. Last week, of course, April 15th, everyone's favorite time of the year. Got to pay those checks to the government. Some of you lucky folks get money back. And I just saw this interesting chart here from First Trust, and nothing,
Oh, you're going to trigger people with this one.
no, I know nothing more controversial to talk with folks about this, but this is just the data, folks. Take it for what it's worth, because I think a lot of intelligent and thoughtful folks out there say people ought to be paying their fair share of taxes. And I'm just always, it sounds right to me, but also you see this data and it's like, oh, so this is data from First Trust and it's from the 2024 tax year. And it's just showing that top 1% of earners, you had to be earning $675,000 to be a top 1% tax. But they pay an average of 26.3% average tax rate compared to the bottom half of folks who earn $54,000 or less pay 3.7%. So, in that context, it's 7 times more. So just food for thought out there. as we move forward into tax time. And it does relate, importantly, to my next few data points, Zach. Moving right along from that controversial subject, I want to talk about the deficit. The deficit, I think, is a primary risk in the market going forward, not just in the next couple of quarters, but in the next several years. It seems that we're spending at a deficit to GDP. That's the measurement of crisis levels, but the economy is very strong, so it's difficulty in Washington, and I think it's a major risk that we're spending so much. But I saw some positive news here for the first time ever about the deficit, it seems. And so there's actually, in this fiscal year, at a 0% government spending increase year over year, which sounds fiscally responsible, but strangely hardly ever happens. Um, the deficit was 22% lower in fiscal year 2025. So the fiscal deficit was 2.1 billion, and now it's 1.64. So it dropped pretty significantly. I think those are good signs, but don't hold your breath, because I think that there will be. It seems like the Democrats will probably take over the Congress in the November election. So all that's subject to change. Zach, anything you want to add there?
Yeah, I mean, look, we can't be running 5% deficit to GDP deficits. It's a non-sustainable path.
This is crisis.
And
This is when a country's at war. This is when there's a huge economic
yeah,
crisis.
and even
2% is the glide path for the last 20 years.
yeah, and even with this administration's proposed budget that they want to put through, I mean, it's gonna swing back up because I mean they want to nearly double, or I'm sorry, increase by I think it was 40% the defense budget from 700-800 billion to 1.3 trillion, some ridiculous number. And so that will kind of continue to put strain on the deficit, and no one wants to fix it, and that's the problem, because no one knows where the line is, and that's the main problem. Is that I think with the Social Security trust fund issue, I'm not as concerned with that because we kind of know when it's going to happen, early
There's
2030s.
a couple
There,
fix that can go
there,
into place.
there's a couple defined fixes that are gonna have to come into play. They're already talking about the cap on Social Security earnings, right? 50,000 for an individual, potentially 100,000 for a couple. There's a few other things like increasing the wage cap and means testing certain things that can extend that timeline. So I'm not as concerned about that particular cliff that we're facing. But with this, we don't know what the line is, right? We have 40 trillion in debt. Is 50 trillion the line, or is it 150 trillion? No one has any
Yeah, we're
idea,
just
and
tiptoeing in the dark.
we're not going to know until we cross it, right? We're not going to know until the investors around the globe who are purchasing U.S. Treasuries just decide, say, what, that's too much. I don't feel like it's money good anymore. That we're going to get paid back this money. So it does worry me because it's something that it just seems that there's no appetite from anyone to really
For
address. And look, there was some,
fiscal responsibility.
the Doge thing, and look, they did some things. They came in with the hatchet instead of a scalpel, and certainly did cut some spending, but now they're raising it elsewhere. But there doesn't really seem to be a concerted effort to say, we need to be at, and you can run a deficit, right? In a growth economy, you can run a deficit. It's not like we have to be back to the 1990s where we're like running a surplus. That's not what needs to happen. It just needs to be a sustainable deficit that matches the growth rate of the economy, which is 2%, 2.5%, something like that. So I'm not really hopeful, honestly, that this is going to get
And so what do we
addressed.
do with this, folks? You want to be with advisors who are aware of this consideration, this worry, this risk. This is not a today problem. As Zach said, we're tiptoeing here in the dark towards the ledge. We don't know when that is. So at some point down the road, and we'll certainly keep an eye on this. Moving forward a little bit, what does it all mean, right? What do we all care about? What's going forward? What's going to happen going forward with the market? So I was just taking a look, Zach, at our last podcast in January, and I made the bold prediction after having a very successful guess at 2025. Boldly predicted that there's an 85% chance that markets would be positive at all, and a 70% chance that markets would be higher by 10%. This is the exact slide from January. And boy, I'll tell you, at the end of March, I was feeling pretty stupid as the market had. It was pretty pretty hard to kind of claim all that back. But it looks, where we are, year to date, we're just over 25% into the year, and markets, are, 4 or 5% positive. We'll see what happens going forward. But I just want to move on to the next slide. I want to give a couple of reasons things can continue higher before I go into some risks. But this is just from our friend Ryan Dietrich at Carson Wealth. He has 2 points here. And it said when the S&P 500 makes a new high in April, which it did last week, for the full year, it's up 18 of the last 19 times. April is typically a pretty trying month for markets. On average, up 18.8%, only negative one of those 19 times. And then what about a 7-day win streak? Mind you, we're coming off a 12-day win streak. I'll show you here in a second. Higher 19 for 20 times in the 20 previous times, for another almost 19% average return. Crazy. And then, of course, corporate earnings are stellar. So let me quickly turn here to a chart here. I just wanted to show you from Carson. Hey, we're on 12 days in a row that the market's been. Oh, here we go. Sorry, 10 times in history, the S&P 500 is up 12% in 13 days. We've had a massive rally with momentum. If you look here towards the right side of that chart, both the 6 and 12 month, it's showing us that of the times it's happened, and there have been 10 previous times, only one was negative. That was during the financial crisis. But this is a pretty broad data set over different market cycles. And, average return, 20%. Now, I'm not saying that. I'm saying there's a 70% chance we get above 10% this year. But this is good momentum. This speaks to some of the technical momentum in the marketplace. So we'll see what
And
things pan out. There's no guarantees here in investing.
and real quick, don't gloss over that last point that you made on that slide of that, earnings projected to be 17% higher in 2026, 6 quarter in a row, 10+%. I mean, that's amazing. And we talked about it back in 2020, like early 25, late 24, that those comps from like 2022, 23, when earnings were pretty fairly low, they were easy bars to clear in 24 and 25. And we said it multiple times that the bar was getting higher to clear in 26 and moving forward. And the companies are clearing it spectacularly. I mean, they're doing so well that all of this performance is completely justified, right? I mean, if you saw back in the decline in March, that was entirely multiple compression. Earnings were
Mhm.
continuing to go higher all throughout that period. So, it's really a testament to
It's
how strong the corporate economy in the U.S. is doing right now.
So to Zach's point, what's one of the top two primary drivers of market growth? One of them certainly earnings growth of the companies. I think sentiment is another. So we talked about both those. It's been exceptional for the market. So thanks, Zach, for that little flashback there. Zach, what about this slide? Who is this guy? Wall Street Journal. 3 articles in the journal this morning about this guy. Do you recognize him at all? Folks at home,
He might be the next Fed chair, but I don't know. We'll
we'll
see
see.
if
I put a question mark. You'll see the new Fed chair question mark. Um,
yeah.
this is Kevin Warsh. He is sitting with the Senate Banking Committee right now about getting approval. We'll see what happens. And I just want to highlight this, folks. There is going to be kind of a seismic shift here in Federal Reserve leadership coming forward. It could probably be this guy, Jerome Powell, who has been, I don't know, often maligned, but often very steady, depending on. I've never seen. It's never been so politicized. It's crazy. But just turning to the last page I have for you, Zach, and I'll hand it over to you. What risks happen? Well, inflation has been above 2% for 6 years. This would be the Federal Reserve and the system that Chair Warsh inherits, or whoever does. Why is inflation so sticky? It's the deficits. The deficits have been very extreme. Government has to sell debt. Interest rates stay high because of that. You have to give higher interest rates to attract buyers, and that's the point there. I have a picture of the president here, and I thought this was interesting, Zach. I saw this in the Wall Street Journal today, and he's talking about all of his candidates, and he said, candidates tend to say everything I want to hear. It's amazing how people change once they have the job. It's too bad, sort of disloyalty, but they've got to do what they think is right. All this to say, right now, the Warsh is on Capitol Hill saying that he's not going to listen to Trump about what Trump wants to do in interest rates. So we'll see what happens. We'll keep you posted here in Finance Footnotes. Zach, turning it over to you.
Yeah, man. So I've been real deep into the AI development. I use it on a daily basis. And I think that it's the whole ball game, moving forward for the next 5 to 10 years is what does this development
I
cycle
know you
look
think
like?
that based on the partners call last week.
I really, I'm on the camp that this is like, up there with the invention of the steam engine and fire. Like, I think you literally cannot overstate the importance of this enough. That's
Okay.
that's my view on it. Not everyone shares that. Some people do share it in a very negative fashion. I tend to be more on the positive, optimistic side of things. Um, and what we're seeing is just a drastic, exponential growth in the capabilities of these models. And what the chart we're looking at right now is this is a different kind of way to look at the expansion of capabilities. So what this is showing is that the different models, so you see GPT, GPT-3 and 2 and 3.5 and 4, Claude Opus 4.6, which is,
These are the different AI models available to the public.
yeah, Claude Opus is through Anthropic. That's not even the newest one anymore. This chart is only a couple of weeks old. There's already two new models that are better than this. And what this is showing is the length of time that the model can be set to a task and perform things autonomously. So just in 2024, we're talking 2 years ago, you essentially couldn't get a model to do anything for longer than a minute. I mean, like you could ask it a question, it would spit a chat bot type thing back at you, and maybe it could do a second task, and that was basically it. As we got to the beginning of last year, 2025, you're like, okay, you can set this model to do something for you, and it will do step one, two, three, four for an hour, right? And then it can actually perform tasks and get things done, and then the cycle would kind of break. Um, just in the last 12 months, it's gone from that to now you can set these models to a end goal and say, I want this thing to be built, I want this app to be built, this website to be coded, and you set the model to the task, and it works for 12 plus hours on its own, iterating, changing
It's
things,
amazing.
thinking about it. Oh, this didn't work, I'm going to try this, and going through and through and through. Um, and it's getting to a point now where you're able to essentially walk away from it, and it will work while you're doing something else. And that's the ultimate promise of this. It's called agentic AI. The ultimate promise is that you have a billion of these agents doing a billion different things. And so, when you talk about GDP growth and how do you grow, right? There's two ways to grow. There's productivity and there's population growth. Population growth we've already talked about is demographics is not trending in a great direction, right? We're expected to hit peak population by the middle of the century. And so it's kind of left to productivity. And so what is the productive capacity of the people that are already working look like in the future in the coming decades? And if you take this for what it's worth, at this point, there's been no sign of this trend slowing down. And so just these charts alone for the immediate term is enough to power the market for the next 24 months. Because what's powering the market right now isn't even the results of the AI. It's just the fact that we're building it. It's the massive amounts of capital expenditure that the hyperscalers are putting into the economy, tens of billions. We're going to spend 700 billion plus this year on data center build out and chips and everything that goes into the AI infrastructure ecosystem. That alone is powering the economy right now. Not even going to like whether it works, right? That's going to be the story of 28 and beyond. Once we've kind of got some of this build out going, you're going to eventually need to see a true return on investment. 100%, you are going to need to see it. But right now, it's just this alone is enough to power the economy forward. And there's no sign of it stopping. There's no sign of build a bigger model, get better results, and that's what's happening right now.
I
And
think
it's
this is
really exciting. And I think
it's
people
seismic.
it's seismic, and I really don't know. I think most people are not really aware enough. They kind of look at the chat bots and they say, oh, I ask it something and, Google gives me an answer. It's like, oh, that's cool. But they haven't really gotten into the agent side of things and have have an LLM, an AI system, truly build something for you. And I'm of the opinion that I'm not as negative on the employment aspect as some people think, because I think that this is going to make competent professionals, supercharged. I still think that people are going to want a person to be the interface for them for a lot of these services, especially even in white collar work. I still think that there's going to be a place for the human in that. Um, and it's going to make people who are able to, because it still makes mistakes, right? I mean, it definitely still does things wrong, and it makes it look amazing. So you could have something. I saw a tweet the other day. It was from a fellow planner who like posted something that a client brought to him, and it was like this beautifully formatted thing that like had his whole plan laid out and everything was like, it looked amazing, right? And if you didn't know what you were looking at, you'd be like, oh, I'm just going to follow this. This is fantastic. But then the planner picked out like four things that was like, well, it got this assumption wrong. It didn't get this piece of the law right. Right. So you still have to know what you're looking for to pick out those things. But for the person who knows what they're looking for, it can make that whole process take, 10% of the time that it would take normally.
Just to kind of piggyback your idea here, Zach, I just, while you were talking, looked up Pew Research poll from last year showed that 51% of American workers are afraid of losing their jobs or job reduction to AI. Like you, I'm optimistic. I think it's going to be much less than this. I think it's going to be hugely accretive. I use it every day, many times to
Yeah.
improve my workflow. But that's not what the general vibe is from
Yeah.
our country.
And look, the next chart is potentially kind of the flip side of that, right? So this is plotting the private sector payrolls versus profits of corporate profits, and there's a 4 quarter lag. So typically, you've kind of seen like labor follow profits, right? As companies make more money, they hire more people, and you're kind of seeing that decouple a little bit because I think companies are getting more out of the people they have.
Aren't
Right.
we
And
at
so you're
max employment though, too, Zach? Just
That's
to
true. Yeah, totally true, right? So there's not a lot of other people to bring into the workforce, right? So you could be seeing just a natural cap of the payroll numbers, right? And especially if you're looking at the immigration statistics, right? I mean, we're at essentially net negative migration right now. That's certainly having an effect on payrolls. So this doesn't necessarily mean that AI is having this effect, but it could mean some of it, right? And it definitely means that companies are being more productive with the people they have. I mean, that's
yes,
just obvious from the data, right?
which
So
is why going back to corporate earnings and why their earnings are
yeah,
growing so much.
yeah. So you are already starting to see that it is having an effect, and we're early innings in the adoption of this stuff, and really how companies can integrate it and get to a place where it actually is accretive to profits. Because there's the term, the AI slop term is out there, right? It does generate a lot of information, right? And there's plenty of anecdotes
And
through.
just to brag, Zach, I have caught in a few errors from time to time. And when you push back on
Definitely.
it, I use chat often. It's like, I don't
Yeah.
think that's right. It's like, oh, you were right to push back on that. Here's the right answer. Like, are you testing
Yeah.
me? Well,
No,
I feel good
definitely
about
makes
it, but come
errors.
on.
Definitely makes errors, and it just makes it so much easier for someone to create a piece of collateral. So if you have, a report that you need to generate, and you're an analyst, and it used to take you a week, well, now I can do it in 5 minutes, and like maybe I'm going to create 100 reports. So now the person who's reading your reports has 100 to read. So like,
Yep.
there's definitely something within organizations where there's the balancing act of like, creating all of this new material and then distilling it down to something that's actually useful. And so we'll get better at that as a society, like as companies, we'll get better at utilizing these tools in ways that are actually accretive. But you're starting to see it. You are really starting to see it, and you're seeing this, the next chart is the evidence of that. Um, anthropomorphism, anthropomorphism.
I wasn't going to
Like
try.
that
It
word?
looks like a German word to me.
Anthropomorphism.
Got it. Nailed it.
This is anthropomorphism, the putting of human traits onto non-human things, right? Um, and so this is just Anthropic's annual revenue run rate, just mirroring the capabilities of the models. You're used to seeing this kind of thing with software companies that start to generate, the network effects and things like that. But usually the numbers on the left are end in M, right? It's like,
Yeah.
yes, you're going exponential with 15 million of revenue to 100 million of revenue, and these are billions, right? They're going exponential on billions of revenue, um, which is just and you know I it's just an amazing thing to watch. These companies grow in the way they are, and we're going to have some mega IPOs probably later in the year, whether it's OpenAI, Anthropic, SpaceX, which is also XAI, another one in there. Some mega IPOs that'll bring some of this stuff to the public markets. Right now, it's all private. Um,
It's a very exciting time. It's bigger than the internet age, it seems,
yeah,
and
I think
the
so.
potential
I
is
think so.
just exceptional. We're living in a very interesting time, and there's a lot of fear around that. A lot of the troglodytes. Who are those people that beat up the looms in France?
Luddites.
Luddites. Yes. Yeah. I mean, listen, I think it's going to be net accretive, and it's such a great chart, Zach.
Yeah. And
This
then
chart.
and what's even more amazing is this next chart, and this is as a result, kind of, this is a week or two old, so it's a little bit higher now that we've rebounded, but um, tech is kind of cheap relative to everything else. I mean, it's like,
Tell
am I
the
going to go
folks at home
buy?
what a peg ratio is.
Yes, so it is the price to earnings growth ratio. So it's not just the price to earnings ratio, but it's the price to the earnings growth. So what
It
is your future
captures,
growth?
yeah.
Yes, and what are you paying for each unit of future growth, essentially?
So
And so
the companies that are growing faster have a better peg ratio.
yes, lower is better in this metric. It's cheaper, essentially. And so, am I going to go buy consumer staples? Which is like the most expensive thing in the market, and it's not growing, but it's defensive, right? Or am I going to buy the fastest growing companies in the market that are cheaper, right? And it's kind of amazing. Even the Mag
It's
7.
incredible. You forget about this. You hear about all the Mag 7 leading the market. You forget that it's just this cheap when you're
Yeah.
looking at growth,
And this is
earnings
just
growth.
such the opposite situation than it was in 2000 when that was all multiple expansion. Those tech
Hmm.
companies were just growing the price you're paying, and there was no real growth underneath all that. This time around, it's all growth. I mean, it's actual earnings. We're seeing it. These companies are earning money, and they're getting rewarded for it as they should. And so now that tech's even cheaper than European stocks, which is absurd that that's the case. Um, so it's certainly not an environment that you would look at and say, oh, we're like due for some major dislocation in this stuff. So on to a couple things that folks have been talking about and clients have been asking about the private credit markets and all the things that you kind of hear about that. So this private credit is the change in lending to businesses that happened after 2008. Essentially, banks got out of that business. Really, banks do not loan to businesses really anymore. It's now generally private companies, so funds and private equity and private credit companies, business development companies are what they're called, that will go seek investors and then lend to these companies that don't have a public presence, aren't traded on the public markets. Um, and it's not an apples to apples comparison when you look at the potential for some sort of contagion risk out of that market versus what the mortgage market was in 2006, 2007. That was 60% of the entire uh, debt load of the country, both household and business. Whereas private credit share of U.S. household and business debt in 2025 is 3%. I mean, it's just it's not a um, truly systemic type of issue. There certainly are some knock-on effects that folks have pointed out, that insurance companies do hold a decent amount of the private credit through through these funds, and that could be a potential, avenue for contagion. I don't want to like say it's not a risk at all, to the market, but certainly folks who are trying to compare it to like the mortgage crisis, it's a very different animal than it was before. But within that market, it's not a pretty picture right now. If you look at the next slide, I mean, you're seeing some massive redemption requests coming in for these funds, really driven by the AI expansion into the moats of these technology companies. So a lot of these companies that were receiving these loans, receiving this credit, were software companies. Um, you know, Companies that did 100 million in revenue, and they had their little niche and their little thing that they provided, and that recurring revenue was generally thought of as bulletproof. It's wide moats. They had their little niche that they service, and companies, the credit companies viewed that as like, hey, this revenue is going to recur for the foreseeable future. Now AI comes in, and you can basically recreate that entire platform in 5 minutes without any coding background. And so that's scaring a lot of folks to say, oh, wait, hold on. Like maybe that $100 million of recurring revenue isn't good. And so that was really the driving factor behind all of these redemption requests that came into these private credit funds. And what you see on this right-hand bar is the dark green is a met redemption request, meaning that was processed, and an unmet redemption request, nearly double what the met was, or nearly the same size as what the met was, meaning that those funds have liquidity provisions that basically say we're gating our redemptions at X%, and you have to wait to get out. I do think a lot of this is just a function of how these things were sold to retail investors. I think a lot of folks didn't really understand what they were buying. I think a lot of folks didn't really understand what they were selling when it comes to this, and were allocating it potentially inappropriately or suboptimally, maybe not inappropriately, but just not, you know, private credit, private equity is meant to be 7 to 10 year capital. It's meant to be something you hold for
Long-term hold.
a full business cycle. And I think some
Yeah.
folks that, looked at the nature of these funds. They're called interval funds or semi-liquid funds, where it's different than it used to be, in that, hey, yeah, you can get out once a month, or you can get out, once a quarter. It's no big deal. And I think folks didn't really read a lot of the fine print and really understand that, hey, these are, even though it's packaged that way, it's still, the underlying investments are really designed to be held for 7, 10 years.
A lot of this
But
crisis, I did just pop in a chart here for us at home there.
love it.
A lot of this concern, real time. A lot of folks at home may know about private credit. Maybe you don't, but Jamie Dimon is the CEO of JP Morgan Bank, the largest bank in the country. And he said several months ago about one of the private debt funds had a problem. And he said something like, when there's one cockroach, there's usually more. And that was kind of the impetus that really got people concerned about
Yeah.
the market. But, he sent his annual shareholder letter last week. And he kind of updated his thought, and he said, quote, the actual credit hasn't gotten much worse. And he finishes, the big point to me is I don't think this is systemic. So, wait, he's just kind of clarifying his earlier thought here that it hasn't been as many cockroaches as possibly perceived. So we'll see as things unfold here. But I think, like you said, Zach,
Yeah.
I don't think there's much
And
reason for concern.
and again, to be clear, from my perspective, I'm again not as negative on people were calling it the SaaS apocalypse, so software as a service apocalypse. Very clever branding, um, which I don't think is as big of a problem as some folks make it out to be, because take Salesforce, for instance, as a major software as a service. Um, every corporate S&P 500 company.
Sorry, Zach. Let me just pull back here. Part of the reason why that some of the funds are having issues because they seem over leveraged to technology companies,
Yes.
including SAS companies. So those companies that have these big exposures to these markets that may be losing market share, possibly to AI, are under a lot of stress. Now, what Zach's saying is that that's just not the case. And the market's actually repricing those SAS companies up higher again recently, including Salesforce and the like.
Yes, and because what I'm thinking is that, you know, if you're an S&P 500 company, I'm a CTO, Chief Technology Officer at an S&P 500 company, and maybe with AI, we could build our own Salesforce internally. That sounds amazing, right? And I can save that seven-figure CRM, Salesforce bill that I don't have to do. But then you think about it and you're like, do I want to take on that data security risk, right? Do I want to take on that breakage risk for our organization? I think the answer is no for almost all of them. I think that these companies, these software platforms are going to get so much better because of AI. They're going to be able to do so many more things with your data that the companies that are using it are still going to pay for it. And maybe you don't need as many seats. Maybe, maybe there are some companies that will go do it themselves. Sure, right? It's a competitive landscape. But I think that Salesforce itself, and I'm just using Salesforce as an example, but there's 100 other, of these software companies. Um, they're going to be so much more efficient, right? They're going to be able to do so many more things with what they have and be more productive. And so I'm not as negative on it because I really think that data security risk is going to be a huge piece of the puzzle moving forward because of how easy it's going to be for bad actors to use AI nefariously, right? To attack these systems. And so I don't think anyone is going to be taking that risk on themselves internally. They're going to use a well-trusted, well-funded company that's their job to protect their data. And so I haven't been as negative on that. And you kind of see the market. I think initially it was like just sell everything software. Now it's rebounded, and I think the market's kind of repricing that concept. So all of that feeds into the fact that the private credit thing I think is potentially a little overblown.
Agreed.
And the last thing we want to look at is just a somewhat um, positive development that I wouldn't have guessed was the case. Um, and this is the percent change in net worth versus the income cohort. So you got top 10%, next 40%, bottom 50% in the 2020s. So since 2020 to 2026, or more than halfway through the decade. What is the percent change in net worth? Now, all income cohorts have seen their net worth grow this decade, but the bottom 50% has actually grown more than double the rest of the top 50%, which is something I wouldn't have guessed. This is from Ben Carlson, a Wealth of Common Sense blog. He always sources really, really good stuff. Now, it's coming from a smaller base, right? Obviously, in absolute terms, it's not equal. But in relative terms, it's certainly a positive development that kind of goes against that K-shaped narrative. You hear that a lot. That we're in a K-shaped economy, and the bottom, is doing worse and worse and worse, and the top's doing better and better and better. Well, this kind of is a data point refuting that. That actually the bottom has kind of come up a little bit. So it's a positive development, and I think something that's really important.
This is in 6 years,
politically and economically.
Yeah, just over the last 6 years. So this is exceptional increase in just the last. Obviously, you have a big dislocation there with COVID, but great way to end, Zach, on a positive note. I think we touched on a lot of great things here in the podcast, folks. If you have any questions, as always, please let us know via email or reach out to our assistants. We're always happy to answer those questions. And we look forward to seeing you next time.